While everyone's been laser focused on inflation, something massive has been happening right under our noses. It's a quiet reversal at the Federal Reserve, one that could be worth $1 trillion. So today, we're going to break down this hidden pivot and what it means for 2026. Let's get to it.
So what was the big story everyone seemed to overlook last year? It wasn't about the rate cuts everyone was talking about. No, it was something much bigger. A fundamental change in direction that didn't make the front pages. We're talking about a brand new cycle of money printing.
And the scale of this shift? It's just staggering. We're talking about $1 trillion. That's the kind of liquidity the Fed is getting ready to pump back into the system. And listen, a number that big doesn't just move the markets, it changes the entire game.
Okay, let's dive into the core of the story. A secret policy change is already happening. Right now, this is really the heart of the matter. So here's the crucial point. The Fed has gone back to quantitative easing, or QE, and that's really just a fancy term for creating new money to buy up government bonds. You see, while they were publicly talking tough on inflation, their actions started pointing in the complete opposite direction. Let's look at why they really had no other choice.
Now, to really get why the Fed is making this secret move, we first have to understand the enormous problem it's trying to solve. There is, quite literally, $1 trillion hole in the US budget, and is creating a pretty dangerous situation.
This problem has a name. It's called a liquidity vacuum. Here's basically how it works. The US government needs to borrow just massive amounts of money by selling bonds. But its borrowing has gotten so huge, it's starting to suck up all the available cash. And that starves the private economy of capital, which puts us at risk of a major recession.
Let's look at the hard numbers, because they really tell the story. The US deficit is sitting at about $1.8 trillion. That is a huge gap to fill. Now, traditionally, foreign investors buy up a lot of this debt, but as you can see from this chart, they're only willing to absorb about $1 trillion of it. And that leaves a massive, massive shortfall.
So here's the result of that. After the foreign buyers take their piece of the pie, we're left with this enormous hole of about $800 billion with no buyer in sight. This is the funding gap. The Treasury has to fill it somehow, and without a buyer, it creates that dangerous vacuum we just talked about.
Look, most people just watch the markets go up and down. This channel is for people who want to understand why they move. If you want to stay ahead of that curve, go ahead and subscribe.
So how in the world do you fill an $800 billion hole without tanking the entire economy? Well, this is where the Fed steps in. And the thing is, they've already started acting. Let's look at the evidence.
You know, the first clue was buried deep inside the Fed's December 2025 statement. They used very, very careful language, saying they would start buying Treasury securities. And that was the signal, the quiet official start of a brand new QE program.
And listen, this wasn't just talk. The actions followed almost immediately. The signal came on December 10th, and by the end of that same month, the Fed's balance sheet had already grown by $39 billion. So this pivot, it's not some theory, it has already begun.
Now, let's add in a little political context here. A new administration is coming in, and the incoming president has been pretty consistent about pushing for a weaker dollar to help boost exports. This political goal just happens to align perfectly with the Fed's new direction. So what does that mean? It means we can probably expect this whole policy to accelerate.
So what does this all mean for us? Well, it means we need to start thinking about inflation a little differently. In this new reality, higher inflation isn't a policy failure. No, it's actually a necessary part of the solution.
You see, the Fed is facing a really difficult trade-off. On one side, you've got an unstable debt market and a looming liquidity crisis. On the other side, you've got the solution, printing money. But that solution comes with a cost, and that cost is higher inflation and a weaker US dollar. And it looks like they've already chosen their path.
So here are the specific outcomes we can probably expect. The US dollar index, or DXY, which measures the dollar's strength, is likely going to fall, possibly targeting that 90 level. And inflation? It might just settle into a new normal of around 4 to 5%. And this won't be treated as a crisis, but more like the cost of doing business.
Okay, so that's the big macro picture. Now, let's bring it down to the markets. How does this hidden pivot actually translate into an investment strategy for 2026? What should you be looking for?
So here's a roadmap for how this could play out. We're expecting a market correction early in the year, mainly because the market is just a bit overbought. But that's just step one. By the second quarter, this new Fed policy is going to become obvious to everyone, and liquidity will come flooding back. That should be the fuel to drive markets to new highs in the second half of the year.
So how do you position yourself for this kind of environment? Well, the outlook for US stocks, represented here by some popular ETFs, is a buy, but you might have to be patient through that earlier volatility. On the flip side, the outlook for the US dollar is a sell because it's going to be under a lot of pressure from this new Fed easing policy.
When you boil it all down, this entire policy has one big goal: to buy time. That's it. The Fed is creating a 3 to 4 year window for the government to finally get its spending under control and fix the deficit. The money printing is a bridge. It is not a permanent solution. And that leaves us with the final and most critical question. You see, the Fed isn't just printing money, it's printing time for the politicians to act. If they use this window to actually bring the deficit down, the system can rebalance itself. But if they fail, we could be facing a much, much bigger crisis down the road. So, will this time be used wisely? That is the real trillion-dollar question.
Most investors are going to spend the rest of the year just chasing headlines and reacting to fear. But the real edge, the real alpha, is in understanding the underlying structure of the market before it becomes common knowledge. So if you want to keep your focus on the signals that actually matter, this is where we do that.